if I've got 20 lenders, probably 19 of them are going to want to stay in the bigger metropolitan areas, and they're not going to lend in the secondary markets, and they're not going to lend in, the lower population areas, and it's getting more and more so that way, that if you're in a rural area, and you've got a property that, you're looking at in a rural area, it's going to be hard to find funding for that deal.
All right, folks, I have with me Jerry Miles. Jerry and his wife, Shelly, are actually founders of Adventure Commercial Capital, and they're basically a commercial lending firm. I wanted to bring him on just so that we can discuss the debt market, how it is right now, what are the changes that we're seeing. So without further ado, welcome, Jerry, to the show, and why don't you go ahead and introduce yourself to our audience?
Yeah, thank you. Thanks for having me. I'm Jerry Miles. Like Vishkar said, the founder of Adventure Commercial Capital. We founded Adventure Commercial Capital 3 years ago, as we've been real estate investors ourselves, and saw a need for a broker in our market in particular that was honest and would treat people fairly. We were having troubles with that, through our own investing. Decided to fill that need ourselves. So.
Interesting. So can you expand on this? You said that you started Adventure Commercial Capital a few years ago. What were you doing before that, and what really kind of made you come into this?
We've been running a commercial roofing business for the last 20 years. To take it back even further, I was in high school, had big plans and big dreams to do big stuff. I was a ball player and wanted to go to college playing ball and things. My 10th grade year, I had my first son. Had to start work. I started putting roofs on, so when I turned 18, I actually, started my own roofing business. Been putting roofs on now, and still have that business running for over 25 years probably now. It's been good to us. It allowed us to start investing in real estate, as we grew. I always knew I didn't want to stay in the roofing business. It's a rough business. I wanted to start a business that, that I wanted my kids to be involved with. I've got 3 sons. I wanted them to be able to be involved. I don't want them to have to, deal with the things I dealt with through my roofing career, as far as the physical labor and a lot of nuances there. I wanted to have something bigger for them and better. And so we started investing in real estate about 10 years ago. Through that, we almost 10, I guess, probably 8 or 9 years ago now, but through that, we, ran into some issues, getting funding, as we were self-employed and different things. And we actually had run into some lending brokers as we ran out of banks to go to. We ran into some, private lending brokers, and I found out that most of them were just not real honest, were overcharging, just taking advantage of clients. And we were being taken advantage of by a couple different ones. Through my research, I found a company that actually sets you up as what they call a business loan broker. So we put up the investment, went to the training for, to learn how to become business loan brokers. So they taught us, we went to a 7-day class. They have a lot of continued education. We're on weekly Zooms with different lenders, learning more about their products and things. And so through that, we, decided we didn't want to do, lending to all businesses, because they have a lot of different options with their capital that they can provide, but we wanted to be involved in real estate. And so we decided to focus primarily on commercial real estate, our niche being, multifamily and development. So now here we are 3 years later, and got a lot going now. So
yeah, that's amazing. So you said you focus primarily on multifamily, and what other asset classes do you focus on outside of multifamily?
Yeah, we can lend on anything commercial real estate related if it has an income, or like in the case of development deals. Probably our best product that we have right now to offer the market is a development program. We have a development line of credit that focuses on larger development, start at $20 million, and this particular lender has lent on projects up to $17 billion. But it's a really innovative product in the market when a lot of banks and things are kind of backing away from development and new construction, I feel like this is probably our most competitive and our best product that we have to offer the public right now. So.
I see. Let's talk about the changes that have occurred recently, right? The inflation has been going up, and then so the Fed had to raise the interest rates. How has that impacted the debt market and the debt rates?
Because of inflation, we've had, the Fed has come and really put a hold on the market by the way they've raised the rates. Sellers, unless they have to sell, they're not selling right now because, when the rates go up, their cash flow and their debt service and everything else goes down, which their NOI is lower now, and so because of that, the values are lower. And so then as you have the rates going up, you also have cap rates going up, because you're not going to buy a property at a 3 cap anymore when your rates are in the 6s, and so then now the cap rates, now you have a lower NOI, and then you have a cap rate that is now doubled, which is going to lower the value as well. And then on top of that, with inflation, there's a lot of aspects to it, but with inflation, insurance rates have gone up. So we've talked to borrowers that were paying $700 a door for insurance a couple years ago or a year ago, and now their new rates are, in the 2000s, per door. And so that's another killer of NOI. Because we've had the inflation and the values have gone up, the slowest moving part of everything is the government, and so when the states are stepping in and they're seeing that values, properties similar were selling for, a way higher purchase price. Now they're asking all these other apartment owners to, pay more taxes as well. So the apartment owners are now having to battle the cities and states and townships, for lower taxes, because that's another killer of their NOI. So it's done a lot, the inflation, not in particular. Inflation itself, as a property owner is great. Inflation's what gotten all these, great returns for apartment owners for so long. For the last couple of years, if you've owned real estate over the last couple of years and you've gotten out of it, you've done really well. But now in this market, it's changed a lot because of that. So.
Right. That's quite true. But how is the debt market really responding in terms of the loan products coming out? Because at one point I was hearing that like typically, a commercial loan will usually be amortized over 25 years, 30 years. But now we're hearing that they're trying to, there are loan products that are out there that are amortizing over 40 years, 45 years, just to kind of keep themselves competitive. Lenders are doing that. Do you see that happening?
I know that that's something that, the agencies are offering. HUD is offering Freddie and Fannie. We're quoting a lot of deals right now through Freddie and Fannie, but I haven't had any deals that fit that box to where Freddie or Fannie are going to say, hey, we're going to go ahead and extend this to 35 years. It's a real tight, it's a real tight, part of the market that they're doing that with. And we haven't seen that. I am seeing a lot more of the 10-year terms, as far as want a fixed rate for 10 years instead of, 2 or 3 or 5 or whatever it is, and the rates are actually more favorable at that 10-year mark right now than they are with the shorter terms. And I'm seeing even, longer interest only periods on the, agency debt as well. So they're doing things like that with the interest only, extended. Right now you can get a 10-year interest only for about the same pricing as a 10-year fixed, P&I, as far as the rates.
Oh, wow.
And
that's very interesting, because that's going to change things around, right? Because that's going to improve your cash flow if it's just interest only, and if it's for 10 years, that's a pretty long period for an IO.
Yeah, it is.
So what other products are you seeing, and how are lenders protecting themselves in this market where obviously it's become much more competitive for the lenders to get business because there's not a lot of activity happening in the market right now?
A good thing right now, and something I've told people in the past year, is just it's good that the lenders right now are still looking at deals. We still have lenders that are pulling out their calculator and they're working on writing deals. We do have some lenders, we've got a big book of lenders that we can pull from right now. We do have some of them that have pulled back as far as the product types that they're lending on. You have a hotel currently, and it's an unflagged hotel, where, it's not a Marriott or a Holiday Inn Express, the big name hotels. If it's not one of those, you're going to have a hard time getting it funded right now. A lot of the lenders have pulled back their leverage. So a lot of the bridge lenders are, where they used to lend, 70 to 80%, on, and they would be real aggressive on future earnings and the future NOI and all that. They're now, we're going to stick at the 60 or 65%, loan to value. And we're going to go off your NOI currently. We're not going to give you credit for what you think the NOI is going to be next year. So they're getting a little more shy in those ways, especially on bridge debt and things. So the private lenders have gotten a little more, a little tighter in general. The agencies, they're still lending. They're still offering a 1.2, 1.25 DSCR in the big markets. If you get into the secondary markets and things like that, the smaller towns, they're going to be more conservative. If you've got a deal that's in a bigger market, Chicago, Columbus, Indianapolis, Cincinnati, they're still going to lend. They're going to be aggressive and try to go after those deals. So,
I see. Okay. And how popular is the floating debt now? Are you seeing that changing? Because I know like a couple of years ago, people were crazy about floating debt because the idea was it's never going to go away. The interest rates are so low. What are you seeing now?
Well, I'm seeing the customers themselves being afraid of them. If they see something with a floating rate, they're going to be scared of it. Right now, most SBA loans are on a month-to-month, floating rate. There's really on SBA, there's really no fixed option at all. And a lot of the bridge debt, it floats month to month right now, and they're going to be, watching the SOFR rate, and they're going to be, 3.5 or 4.5 over SOFR, and it's going to go month to month. The public themselves are really leery of those deals, and we haven't closed any deals with any floating rates, just because, the lenders like the floating rate, and that's a way for them to protect themselves. But the borrowers, I've not found a borrower that's willing to sign on a floating rate, in the current market. So,
right. I know it makes sense. In terms of the deals that are coming to you, and you look at the underwriting and everything, are you seeing like a lower debt amount that people are trying to leverage, or are you still seeing the maximum possible that they can leverage from the bank? In terms of just the sentiment of the buyer, are you seeing they're more afraid of getting that leverage?
I don't see them afraid of getting more leverage. I see it getting harder for a lot of the borrowers that we deal with are syndicators, and I see a lot of them that are struggling with coming up with the capital needed to close their deals. That part of the market is getting tougher. But as far as them being afraid to take on more debt, I don't really see that. When they're taking on the debt, they're gonna be taking it on with the cash flow from the apartment. So, or whatever the business is there, it's going to be a cash flowing asset, and they're going to be able to take care of it. But most borrowers I've talked to are still going after as much debt as they can get. So.
Interesting. Okay. Where do you see this headed in the future in terms of the debt market? I know it's been a tough year for us as buyers, and I know it's all over, even for sellers who want to sell. Like the real estate industry has really slowed down, but I see some movement happening now. How do you see the debt market pivoting, and what are the talks in the debt circles about the changes that are coming in the debt market in the future?
As far as the debt market itself, when we're looking at multifamily, the most stable things the most stable products for multifamily in the market, of course, are, Freddie and Fannie. So if you're buying deals that are fitting in that box, that's products that I don't believe are going to go away. They're put here in place. They're government agencies. They have their allotment of money every year that they're supposed to use and lend out, and supposed to help with providing affordable housing. And so I don't see those changing a whole lot. As far as the private market, when we're looking at bridge debt, money to help people stabilize properties and things like that, that is ever changing. If you watch the news and watch all the experts and the gurus, you'll drive yourself crazy because it changes daily on, whether we're going to go into, quantitative tightening where they're going to tighten the money supply up, or, if we're going to go into a recession, or if we're going to, or if COVID's coming back and it's going to cause inflation to run rampant again and things are going to shut down. I mean, there's so many aspects to it. What I'm seeing, in general, the lenders are wanting to lend to quality assets. And that's another change I've seen, since COVID, is the type of assets. And then also since, we've had the interest rate hikes, is the type of assets that lenders are wanting to lend on. They're looking for the nicer assets in the nicer locations. If I've got 20 lenders, probably 19 of them are going to want to stay in the bigger metropolitan areas, and they're not going to lend in the secondary markets, and they're not going to lend in, the lower population areas, and it's getting more and more so that way, that if you're in a rural area, and you've got a property that, you're looking at in a rural area, it's going to be hard to find funding for that deal, outside of a local bank. And then a lot of the local banks, have been hit with, the banking industry isn't doing so well right now. And so that's getting tougher to fund as well. So a lot of those deals are going to have to go to, owner finance and things like that. But staying in the bigger markets, that are growing, is very important to being able to get your deals funded. And then also in the future, if we do have a big market crash, as I've seen the lenders doing currently, is they're trying to stay in those markets, they're going to tighten up their belt even more, and they're going to want to stay in those markets even more. So as you're looking to sell a property that you have or get out of a property, being in the nicer markets and the nicer neighborhoods in those markets is going to be more and more important.
I see. It's interesting that we're talking about this due diligence that the lenders do, because a lot of times when people are starting in real estate or they want to invest in real estate, there's always this fear around leverage. And one of the things that we know as real estate investors is that the lenders do as much due diligence, if not more, as the investors that are doing it on the asset, because they're actually the biggest piece of the pie in terms of the capital coming in. And so really they have to decide whether they're going to lend on that asset or not. So it's really a team effort between the lenders and the investors that helps actually get the asset, the operators buy.
Yeah, for sure. The lender can be your best friend. If you're having trouble finding funding for a deal, you need to reconsider that deal and say, hey, these lenders are looking at way more deals than I'm ever looking at. As an investor, they're, we're looking at 20 or 30 times the deals that a borrower is looking at every day. We're seeing which ones are defaulting. We're seeing which ones are doing well. And so when the lender is looking at that and they're saying, hey, we can't lend on this deal, then maybe you as a borrower need to turn around and say, hey, why is this? And maybe I need to look at a different deal.
Yeah. Jerry, before we move on, how can people get in touch with you if if they have, lending needs and they want a commercial loan?
Probably the easiest way, my email, my phone, or how everybody gets a hold of me. Text message, a phone call, or email. On Instagram, it is Jerry Sells Money. So you can reach out there. But my cell phone, my email, I don't know if you will put it in.
I will put it in the notes for people to reach out to you. Well, thank you so much, Jerry, for joining me. This was a very fun discussion and very eye-opening for me. And I'll see you all next time. Thank you so much, everybody, for joining me.